Silver and gold didn't just crash in 2026. They exposed how fragile the entire paper metals system really is. Imagine waking up, checking your screen, and seeing the price of gold and silver slashed like someone hit the delete key on your portfolio. That's what traders lived through at the end of January. It felt like the end of the bull market. But what if it was only the opening scene? In this video, we're going to unpack why gold and silver just had one of their wildest breakdowns in decades, why this isn't a normal correction, why the real crisis hasn't even started yet, and what the panic cycle in 2026 could mean for your money going into 2032. And stay with me, because near the end I'll walk through what this chaos really sets up for the next big move in metals. First, the crash that wasn't. On January 30th, 2026, as Kerry Lutz sat down with Martin Armstrong, gold was down roughly $600 in a single day, and silver had just seen one of the nastiest one-day plunges traders have ever seen. The move was violent enough that a bunch of people instantly jumped to the same conclusion. That's it. The top is in. Game over for gold and silver. Armstrong's take? Not even close. He explained that most of the big move up in metals before the crash wasn't a classic retail mania with everyone piling in at any price. It was driven by short covering. In plain English, big players who had bet against gold and especially silver got squeezed and were forced to buy back in at higher and higher prices. That fuels fast rallies, but it doesn't feel the same as a long, slow, greedy bubble with everyone bragging about their gold coins at backyard barbecues. Then, when the music stopped, that same structure made the drop brutal. Once the short covering wave was done, there was nothing underneath it. No deep layer of new long-term buyers. Just traders who had been using leverage and tight stops. So when selling started, it fed on itself. But here's where it gets weird. They're puking silver. Armstrong said something in that interview that perfectly sums up how broken the market was in that moment. Refiners and wholesalers were puking silver. People who had physical silver at those new high prices started dumping it on the market. At the same time, refiners had so much product coming in that some of them literally stopped accepting it or refused to advance any money against it because they weren't sure how quickly they could move it through the system. Small dealers, who normally buy from the public and flip it to wholesalers the next day, suddenly couldn't do that. If it takes 2 or 3 months to get paid, most of those guys just can't carry that risk. So what happens? They stop buying. Liquidity dries up right when price volatility explodes. That's how you get both shortage talk and nobody's buying talk at the same time. The plumbing of the market is seizing up while the chart looks like a heart attack. From the outside, it looks like a simple crash. On the inside, it's a stress test of the paper system that sets price for metals, especially in the West. This isn't 1980 all over again. If you've been around metals long enough, every big move gets compared to 1980. Gold going vertical, then collapsing, Volcker, crazy rates, the whole thing. Armstrong was there for that run, and he points out something most people forget. That price spike in gold happened in about 6 weeks, driven by a huge geopolitical shock when Russia invaded Afghanistan. It wasn't just inflation, it was fear. In 2026, the backdrop is very different, even if the price candles look just as wild on your screen. Armstrong calls what we're living through a perfect storm. Shortages in metals, a lack of refining capacity, a sovereign debt crisis spreading across the globe, and rising war risk all at the same time. That's not the same as a one-off blow-off top. According to him, the computers he uses in his Socrates model are not saying this is the end of the bull market. Instead, they're flagging what he calls an inflection point, a sharp pullback inside a much bigger long-term advance. Think of it like a wave crashing on the beach while the tide is still clearly coming in. He even suggests that after this smash we could see a temporary low, then a rebound as we move into the core of 2026's panic cycle. If you hear panic cycle and think of some astrology-sounding gimmick, that's not what he means. In Armstrong's language, a panic cycle is a period when a market doesn't just trend smoothly up or down, it takes out both sides. Here's how he described it. Imagine you're a trader. One day, the market rips up and blows past yesterday's high. You think, okay, breakout. Then by the afternoon, it reverses so hard that it breaks yesterday's low too. That kind of action wrecks both bulls and bears. Stops get hit on both sides. People swear off trading for weeks. That's a panic cycle. His Socrates model had flagged 2026 as a panic cycle year, not just for metals, but for the euro and other major markets, with particular focus around March-May as a time window when that energy peaks. Which means the crazy day you just lived through might not be the climactic blow-off. It might just be one of several nasty swings in a much more chaotic year. Why the paper market is losing control. Now let's zoom out. One of the core ideas in this conversation is that the center of gravity in metals pricing is shifting from west to east. For decades, COMEX in New York has been the main stage where futures contracts set the global spot price for gold and silver, even though most people buying jewelry, coins, or bars never touch those paper contracts. But Armstrong and others argue that COMEX is slowly losing that grip. Why? Because physical demand in Asia keeps growing, and that demand doesn't care what a Western speculator thinks is too high. You've got strong physical buying in Asia, especially as people there remember currency crises and capital controls in real time. Massive industrial demand for silver in things like electric vehicles, solar panels, electronics, even military gear like missiles, with no real substitute. Years of underinvestment in mining and refining capacity because prices were too low for producers to ramp up. That's why you keep hearing about deficits in silver, more metal going out than coming in, and why every dip gets quietly soaked up by someone who plans on holding it for a long time, not trading it for a week. So when a shock hits and futures markets in the West go haywire, you get this weird disconnect. The paper price dives, but physical premiums in some regions barely move or even rise as people buy the dip. That's what Armstrong means when he says this isn't a normal correction inside a clean, healthy system. It's a stress test of the paper system itself. Armstrong's big picture has always been about more than charts. In this interview, he ties the metals chaos directly into three things: sovereign debt, war risk, and currency credibility. He argues that we're in a global sovereign debt crisis, where major governments have borrowed so much that the old tricks printing, extending, pretending stop working smoothly. Europe is structurally fragile because the euro was built with a common currency but not a common consolidated debt, which makes who blows up next a constant game. When governments get cornered financially, they often look for an external enemy because it's easier to blame Putin or whoever than to admit they mismanaged the books. In that kind of world, capital does something very simple. It looks for safety. Historically, that safety rotates. Before World War I, London and the British pound were the hub. After World War II, it shifted to New York and the dollar. People didn't flock there because of some magical backing. They went because that's where productivity and deep markets were. Armstrong pushes hard against the simplistic fiat bad, gold good meme. He says the real backing of any currency is the productive power of its people. After World War II, both Japan and Germany became economic powerhouses with almost no gold because they rebuilt their economies and manufactured things the world wanted. If raw commodities alone made a currency king, he points out, Russia with its massive commodity base should be number one, and it isn't. So where do metals fit into this? In his view, they're not some magic button that fixes everything. They're a barometer of confidence. When trust in governments and their debt starts to break down, gold and silver don't move because of a neat inflation formula. They move because capital is running away from something: debt, war, political chaos. That's why he expects the bull market in metals to extend all the way into around 2032, with major spikes along the way. What about the crazy long-term price targets? In the interview, Carey reminds Armstrong of a bold call: gold hitting 5,000, then shooting quickly toward 10,000 once that level breaks, because there isn't much resistance above it. Armstrong doesn't back away from that idea. He ties it into the same long-term window, out toward 2032, where he also sees silver potentially reaching around $165 an ounce or higher. Do those numbers sound insane if you're used to gold at 1,800 and silver under 30? Absolutely. But remember, we just saw gold violently smash through the 5,000 barrier and silver blast into triple digits before this latest flush. What sounded impossible a year ago already happened. The question now isn't, can gold ever hit 5,000? It's, was that gap up and crash just the first big repricing event? Recent analysis of the January move shows gold trading in a band just over 5,000 and silver around 107 to 112 before the breakdown, with silver's move described as a parabolic squeeze driven by inventory depletion and panic buying from industry. Other market recaps describe the January plunge as one of the harshest one-day metals drops in decades. Those are not normal daily candles. Those are the system is shaking candles. The real challenge for investors now. So where does that leave you if you own metals or you're thinking about it? Armstrong's view creates a big emotional challenge. You have to mentally separate violent short-term pain from long-term structural change. That's hard when your account is blinking red. Here's the fork in the road he basically lays out. If you treat every spike as the end and every crash as proof it was all a bubble, you're going to keep chopping yourself up, buying high, selling low, and fighting the very panic cycles his model warned about. If you see the current chaos as part of a multi-year storm, driven by debt, war risk, and shifting power from Western paper markets to Eastern physical markets, you're more likely to focus on position size, time horizon, and staying solvent through the swings. That doesn't mean just hodl and never think. It means you stop expecting a smooth line and start expecting exactly what we're seeing: gap ups, flash crashes, and headlines screaming in both directions, especially into the heavy 2026 March-May window. Panics are designed to shake people out, not just technically, but mentally. The deeper story behind the crash? Let's tie this together like a story. Chapter 1. Metals grind higher for years, ignored by most people, while the world quietly piles up more debt, fights more expensive wars, and experiments with things like sanctions, capital controls, and weaponized payment systems. Chapter 2. Confidence starts to wobble. Major institutions and governments quietly move some wealth into gold and silver. Physical demand drains Western inventories faster than they can be refilled. Chapter 3. A trigger hits. Maybe it's a central bank surprise, a political shock, or a banking scare. Prices explode higher as shorts get squeezed, futures players scramble, and the headlines finally notice. Chapter 4. The same leverage that drove the melt-up drives a sickening flush. People who got in late panic out. Commentators declare the bull dead. But under the surface, the core problems, sovereign debt stress, war risk, structural supply issues, are still there, and the people who understand that quietly use the chaos to reposition. Armstrong is basically saying we're somewhere between chapters 3 and 4, not at the final page. How this sets up the next move. If 2026 really is a panic cycle year for metals, currencies, and bonds, then these kinds of wild swings are not bugs. They're features. His model expects more of them, especially as we move deeper into the year. That means expect more days where both bulls and bears get wrecked in the same session. Expect more headlines about record crashes right next to new all-time highs within months of each other. Expect the gap between paper markets and physical reality, especially in silver, to get tested again and again as Western futures and Eastern buyers clash. And over the longer arc into 2032, he still sees higher highs for both gold and silver, not because money printing automatically equals price, but because confidence in government promises, debt systems, and even borders themselves is breaking down. In other words, this crash is not a full stop sentence, it's a comma. If you want to see exactly how this panic cycle could hit stocks, currencies, and metals next, watch the next video on your screen. If you have thoughts on today's topic or something you'd like me to dig deeper into, feel free to leave a comment. I always appreciate the conversation. And if you got value from this, tap like, subscribe to the channel, and hit the alert bell so you're here for the next breakdown. See you next time.